Hey folks, this is Eric with Integrity Credit Solutions. Hey, I wanted to go over the frustrating 600 credit score. If your credit score is right around 600, it can be aggravating because your score is really not all that bad, but it's not really good either. It's not good enough to qualify for most mortgages without a lot of cash down, and it's not good enough to get you a really good interest rate on a car, truck, or SUV. But it's not horrible either. Okay, but here are a few things that you can do to increase your credit score quickly. But first I want to go over the breakdown of how your score is calculated so it'll make better sense to you. 35% of your credit score is your past credit history, how well you've paid your bills, so on in the past. The next biggest area is 30%, and that's your debt ratios. Now your debt ratios are determined by your limits of your credit limit versus how much you owe. So if you have a $200 credit card and you owe $100, that means you have a 50% debt ratio because you owe half. Well, we'll get more into that in just a few minutes. Okay, now with debt ratios, the 30% is not across the board. What I mean by that is there's two different types of accounts that you need to know about. One is an installment account. An installment account is like an auto loan or a personal loan. It has a predetermined number of installment payments. The next type of account is called a revolving account. A revolving account does not have a predetermined number of payments. It can go forever. The best example of that, of a revolving account, is a credit card. Okay? The debt ratio on a personal loan or on auto loan, it is calculated into your credit score, but it's not that significant. And the reason is because those accounts are designed to be maxed out from the time that you first open them up. When you drive your new car off the lot, if you borrowed $20,000, that's your balance. So it's maxed out. It wouldn't make sense to crush your credit score because you bought a car. But on a credit card, it's entirely different, because if you get a $200, $5,000 credit card, whatever the number is, in the mail, generally there's no balance on it. And FICO scores the debt ratio on there as 30% of your credit score. So it's very important that you keep that less than 20% at all times. Well, I don't want to get too far in advance, too far ahead. But the next area is 15%. That's the average age of your accounts. So the longer your accounts are open, the higher your credit score is going to be. Most of the time, people that have 750 credit scores and up, they've had a mortgage for several years. Those are accounts that are generally open from 15 to 30 years. Oh, and they also have credit cards that have been open for long periods of time. Okay? The next area is your mix of credit. And that means the type of credit, like a mortgage or an installment loan or revolving account. And the last area is inquiries. This is an inquiry is every time you have your credit pulled. You just want to keep these to a minimum, especially until you get your credit scores up where you know pretty much you're going to be approved for the loan that you're applying for. If you have bad credit, you don't want to go around having everybody pull your credit, because it's going to continue to drop your score. All right, back to here. If you don't have any credit cards open and you're in the high 500s, right around 600, opening up a credit card is going to drastically increase your credit score, because especially if you keep it below this 20%. So let's go back to the $200 credit card example. If you've got a $200 credit card, the 20% is 40. It's $40. 20% of 200. If you do that, it's going to cause your credit score to skyrocket because you're activating this part of your credit score. But you know what else it's doing? As you make payments, you're going to impact this portion of your credit score, your credit history. It impacts your debt ratio. Okay? Now, if you did not have an account open, it's also going to help you out here with your mix of credit. So that's 75% of the factors that impact your credit score that one credit card is affecting. So if you don't have a credit card, open one. So I know you're probably wondering, Eric, I got bad credit. How am I going to open one? Well, there are a few options out there. The best option in the beginning can be a secured card. A secured card is where you send in a deposit. Most of them start around $200-250 to a credit card company, and that's the amount of your credit line. So, but even though you send that deposit in, you still want to maintain that 20% or less. And it's going to score exactly like a standard card would on your credit score. But let's say that you do have credit cards open. You've got $2,000 worth of credit cards and they're maxed out. Many times when people are stuck around 600 and they do have credit cards open, it's because these are maxed out. Okay? Having them maxed out is almost as bad as not having them at all, as far as your credit score is concerned. So if that's the case, you need to create a plan to get these paid down as quickly as possible. Okay? And there are other ways to do this. As you start to see your scores increase, once you're over about 610, 620, you start paying these down, your credit score starts to go up. Call your credit card companies and ask them for a limit increase if you've never had late payments with these companies. Many times they will increase your limit. So let's say you have 4 cards at $500. Okay, and all of these are maxed out, and you start to pay them down. You get them paid down to $400 each, and your credit score starts to go up. Well, all of a sudden here you're at about an 80% debt ratio. That will cause your score to go up. But let's say they increase, 2 of these increase them to $750. So all of a sudden you've got $750. $2,500, you owe $16. You just dropped your debt ratio down to about 60%. That's going to cause your credit scores to go up even more. So it's not necessarily just the dollar amount, it's the percentage, it's the amount, or it's the percentage that you owe in relation to your limits. So there you have it, folks. That's going to help you get that credit score up. The difference between a 600 and a 650 isn't that much, and it doesn't take long to get your scores to jump 50 points, not long at all. So open up your credit cards, get your debt ratios paid down. It could be the difference between whether or not you can buy a home or not, whether or not you qualify for 15% on a car loan or 8%. That's huge. It's life-changing. It's the beginning of you owning your dream home and climbing out of debt because you're not paying as much in interest every month. So you don't have to deal with that 600 credit score any longer than you want to. Take action. If you have any questions, leave a comment below. Subscribe to our video and ask questions if you have them. Thanks a lot and have a great day.